This wasn't coincidental that this just happened right after Trump announced the new Fed chair is going to be Kevin Warsh.
Yeah, and this is a big deal. So Kevin Warsh, as you guys may or may not know, super pedigreed, right? He was definitely one of the Fed board governors for a long, long time. But what's really interesting is that he was right in the heyday in 2008. And so he had all these. I love this guy because here's why. Basically, his statement was bad loans shouldn't be papered over by policy bailouts. I could not agree more. So he's more of a free market thinker. He's like, you got to let these things kind of go the way that they're supposed to go. And I like, he was really, really critical during the 2008 crisis. But he raised his hand like around all this issue. And I think this is a really, really smart thing to put a spotlight on.
Yeah. And, he's definitely more hawkish than who they were talking about was going to be appointed to that position. I can't remember his name off the top of my head. But because of that, I think everyone is seeing the writing on the wall that rates are not plummeting anytime soon and that, we can't pretend any longer because now we have a problem.
Yeah, and if you want to, his track record is all about no bailouts. So for those of you that agree with that, he just go back and look at his record. So that's not a bad thing. So what happens when there's no bailouts? By the way, this is not Main Street. This is Wall Street. Nobody's going to want to bail out to Wall Street. By the way, I've been through that, and 2008 was not one of those. Well, I guess it kind of was, but mostly it was a bailout for Main Street and Wall Street. But because some of these banks were teetering, that's for sure. But this is very, very, very different. And it's almost not going to be noticed at the Main Street level. However, if you have, let's say, money in the market, and your quarterly statement that you probably don't completely understand because it's so complex, and you have money in your 401ks or your retirement or whatever, you could see a little bit of a hit depending on the allocations, of course. But also, I don't know if this is the first one. What this did was this confirmed what we all thought, and I think that's probably the most interesting thing.
Yeah. Yep. So that's going to be a big deal, and that's kind of what's triggering this. And this is kind of the first domino, right? Because a lot of these multifamily deals with banks as well as other private lenders are also in the same situation. And so, BlackRock is a big company, and for them to do this, it's going to signal to a lot of other companies that are debating on what to do. And you're probably going to see more of this going into 2026.
Yeah, guys, and you guys might have known, we've talked about this, our company's not immune either. Like, our values have gone down from where they were as well. The whole industry has, right? And we did some refinancing and we did some financing during that period of time. And we are battling the same battle. The difference is that, as you guys know, we kind of sat back and we didn't hit the pedal on the gas like a lot of people, right? There are some people about 30, 40, 50, 60 deals during that period of time. And they are for sure toast. And they're trying to figure all this out. And so, luckily we've been in business 25 years where we had, call it 20 years of very successful growth. And our loan to values are really, really, really in good shape. I mean, we're somewhere in the 50s. So, but not everyone was like that. When you buy something in this space, you expect to refi out later. That is the game. Like whether you're building or whether you're buying, your goal is to at least have the property worth more, right? And so that was the bet. Well, that hasn't worked. So if people that bought in 22, 23, 24, let's say, probably 21, 22, 23 more accurately, they're in trouble. Those values are down. Those cap rates are up. Those values are 20, 30, 40% low. In some cases, they might even spiral even more. So as these private credit companies, that maybe got money from BlackRock or even somebody else start to show their hands, what you'll see a lot more of the stuff up on the market. And what will happen? The LPs will finally realize that they may or may not be still alive in the game. Their money could be dead potentially, if the sponsor can hold it through this cycle. And that's the whole game. Like, how long can you kick the can down the road? Because just because a property's worth less doesn't mean you need to dump it. And so if you can hold it another year, 2 years, 3 years, then you're probably going to be okay. And there's a whole nother show there as to why. But in the short term, if there's a loan maturity, which is the real issue, which is why we showed you the graph, then all of a sudden that's where the rubber hits the road. That's where the math hits the spreadsheet, and the cash flow's gone, and the who's going to fund something, who's going to do another $10 or $15 million check, like in that example I said, just to keep an asset. So that's what's going on behind the scenes with all these sponsors. They're working with their various lenders, and some are really, really working with people, and some are not. And so they have their own pressures, right? And so what Danille was talking about earlier was, while we saw the first cracks, let's call it year 1 or year 2, those debt funds were still raising capital. Mm-hmm. And they were because why? Because they haven't taken back these assets. So maybe they didn't accurately know what the values were worth. And of course, if rates would have went down, things could have reversed. Cap rates can always compress down, but they didn't. And so now what's happening is, the cards are being shown. It's the end of the game. It's like a Texas Hold'em game where everybody throws their cards down, and it is what it is. Whatever's on the flop is what is on the flop. And where we're sitting at is, these mid fives to low 6 interest rates. They're not going to come down to where they were. You got higher expenses, and your occupancies are teetering in a lot of markets because there's so much product that's hit the market. It's really a renter's market right now. They have a lot of choices.